Hello, today is Monday, December 16th. It is our last training of 2024, and we're going to go over Schedule C's, mastering small business income and expenses. Um, there are many scenarios, and when you will encounter a situation where you will have a Schedule C client. So Schedule C is the IRS form. It's used to report profit or loss from a sole proprietorship. It's part of the 1040 form and it's filed as part of your personal tax return. Many individuals believe when they have a business that they have a separate return for their business. That is the case when you have a partnership or you have a sole proprietorship where you have a corporation, whether it's a S Corp or a C Corp. Those have different forms, the 1065 or the 1120S or C. However, when they just have a regular sole proprietorship or a LLC, it is reported on the personal tax return on a Schedule C. It is required to be filed every year that your business is in operation. The businesses that qualify for a Schedule C are the sole proprietorship. That's where you're the sole owner. Everything is in your EIN or your social security. Or a single member LLC is treated as a disregarded entity, and independent contractors as gig workers. You have Uber, DoorDash, all of those, Amazon's, Flex, those type of things. They're independent contractors. There's other Medicaid drivers, other professions that are independent contractors. So their income gets reported on a Schedule C. When you report income on a set Schedule C, it's your gross receipts, your returns and allowance, and other income, which can include interest and bartering income, as well as miscellaneous income. Difference between business income and W-2 income is that with W-2 income, the taxes are taxed when you earn the income. So when you get paid, your taxes are taken out. However, that's a different case when you own a business. You pay your taxes after the fact. The difference is that you get to subtract your expenses from your income, and then what's left is what you pay taxes on. So there's taxable income. The taxable income is what's left after your expenses are deducted. Some of the allowable business expenses, and this is just some, not all, your advertising costs, your travel, if it's a business trip, office supplies, and professional fees. You also have one of the biggest missed deduction is mileage. You have your standard mileage rate, which is about 68 cents per mile. It goes up every year due to inflation. And you have your actual expenses, and you must have proper record keeping. You choose whether you want to take standard mileage rate or actual expenses. You cannot take both. However, in both situations, you do need to know the beginning mileage at the beginning of the year and the ending mileage at the end of the year. It's very important to keep record of that. If you're a person that does not keep record of your mileage, every time that you go for an oil change, write it down, take a photo, but definitely keep your mileage. It's an expense that's missed, and how a lot of businesses leave money on the table. Then you have the home office deduction. It must be The rules for home office is that it must be exclusive use, it must be regularly used, and it must be a principal place of business. So you can't have a situation where you have an office, you have a job, or you have an office, or you run your business elsewhere, and you still maybe in the nighttime do a couple of things at your home computer. If it's not your principal place of business, you cannot take the home office deduction. Then you have your depreciating business assets. Those are business expenses that are more of a higher price, sometimes computers, equipment, cars, houses, whatever your line of business is. If you buy higher dollar, equipment or priced items, those would be considered depreciating business assets. And it's you get to depreciate the cost of it over the lifetime of the asset. Record keeping is very essential and very important for Schedule C business owners, not even for Schedule C business owners, but for all business owners. It requires you to organize your receipts, track your income, log your expenses, and maintain bank statements. It is very important, and those records should be kept for at least 3 years from the date you file your return. In a situation where you have assets, depreciation assets, you keep your receipts for how long, for the length of time for the asset. There are ways to avoid common Schedule C mistakes. One of the most important and one that I speak to all my clients about is commingling funds. The IRS does not like it, they frown upon it, and sometimes they even fine. It's the easiest way to lose an audit. And that's basically mixing personal and business expenses together. If you have a business, keep your account separate from your personal transactions. Then there's unreported income. Sometimes people don't report their income because it's cash or it's bartered. Overstating expenses. A lot of people just want to write everything off, thinking that that's good. It's not a good look. It's a big red flag. And after a while, the IRS dooms your business as a hobby. And of course, the missing deadlines, which will cause you, excuse me, to file late, and which also cause you to rack up penalties and fines. Let's look at a couple of scenarios. Last year, you acquired an old table for $20. You restored the table and then decided to sell it over a year ago. Eventually, you sold it for $100, leaving you with an $80 gain. You used a third-party payment processor called Venmo to make the sale. They sent you a 1099K for the $80 difference. Since you sold the table for more than you paid, you would report that sale on your income tax return, and that would be considered a capital gain. The same thing goes for reselling items. You purchase tickets for a music event through an online platform, and then you decided that you wanted to resell it because you weren't going anymore. You purchased the ticket for $100 more than what you paid for it, and you use PayPal. PayPal is going to send you a 1099 for that transaction, and you report that income on your taxes. I hope that's understandable. Say you purchased a TV 10 years ago for $400, and after a while you upgrade to a bigger TV and you decide to sell that TV online on the marketplace, on Facebook Marketplace, for $50. Since you sold the TV at a loss, you would not need to pay taxes on the sale, even if you receive a 1099K. You would basically just have to document the details of the sale. You still have to report the loss on your tax return, but it will not affect your taxes. Let's say you ran a side hustle selling goods for a profit, such as produce at a farmer's market, and you use multiple payment methods like Cash App, Square, things of that nature. In January, Square is going to send you a 1099K with a list of all the gross receipts from those transactions. Because you sold the goods for a profit, it's treated as a business and you would need to pay taxes on that income. If you have a hobby, it's a little bit different. So you have a hobby creating paintings or selling things on Etsy to make a profit, or you start depending on your hobby. If you start depending on your hobby for a livelihood, it's no longer a hobby, it now becomes a business. Assuming you make income from your hobby, you still need to report any profits you make. Hobby sale income is classified as additional income to the IRS. If you get a 1099-K for those transactions, you report it on your Schedule 1. Unfortunately, you cannot deduct hobby expenses from your hobby income as you would deduct business expenses. For example, if you crochet and sell them on Etsy, you will not be able to deduct the cost of the yarn to reduce your profit. When you rent out personal property, sometimes household tools, lawn mowers, cars, maybe you have a event planning business, you have marquees, you have numbers, you have things to blow up balloons, you have um, chairs and tables for events, tablecloths, things of that nature. You must report that income on your tax return. If you occasionally rent out yard equipment during the summer and you receive payment through PayPal, you may receive a 1099-K. So you need to report that income for all the rental transactions. This is what a 1099-K looks like. And the amounts change every year. So I can't even quote to you what the amounts are this year because the IRS is currently working on it. Last year was $600, then they change it to $2,000, then they change it to $5,000. We just have to wait to see what they change it as far as what's reportable or not and what's taxable. So that's how you do a Schedule C. In the next video, I am going to actually work through a Schedule C and show you how to do it in the software. Thank you and have a great day.